When you open a price chart, you're looking at price, but the way that price is visualized and how it comes across can completely change your interpretation. Now, there's no one size fits all chart type. Each offers unique strengths and weaknesses depending on your strategy, time frame, and what you're exactly trying to see. So today, I'm going to be covering in this lesson the 7 most important chart types, how they're calculated, and when it's most appropriate to use them. Ultimately, this will be something for you to become familiar with and comfortable with, and to find the chart type that most resonates with you and your trading time horizon and your strategy. So first of all, this is Microsoft. You can see this is a stock chart, and what I have here is a candlestick pattern. Now, the candlestick chart, this is my go-to chart candlestick to look at, and there's all sorts of patterns that you can find on a candlestick chart. There's many different ways of interpreting the charts using candlesticks. Originally, this came from Japanese rice traders, and it was just a way of visualizing the Japanese rice market. I find it very helpful. It's my go-to chart pattern. Now, the way it's calculated, what it shows you, if you take a single candlestick, let's take this bullish candlestick. The open is the first price of the period. That's the bottom of the body of the candlestick. The close is the closing price. That's the last price of that candlestick for that day's trading. The high is that top of that wick, and the low is the bottom of the wick. So what this shows you, it shows you the open, the high, so the open, the close, the high, and the low. Okay, that's what you see. Open, close, high, low. Similarly, with a candlestick that's going lower, the open of that candlestick is shown here. You see this 24th of Feb candlestick, that's the open. There's the close. The high is the top of that wick, the low is the bottom of that wick. The next day, you can see there's the open, there's the close, there's the low, and there's the high. Now, this is ideal for pattern recognition, market psychology, short to medium term trading. If you look here on a weekly chart, you can see, there's some really nice chart patterns. You can see here there's a bullish engulfing bar. This weekly price pattern completely engulfs the previous day candle. That is at a key sort of support level. You can see here, decent support level. You've got a lovely bullish engulfing bar from a support level, and that ends up being a catapult launching point for price to move higher. These are my go-to chart patterns that I like to use. The other chart pattern that you can use is the open high low close bar chart. Let me show you. Here it is. Now, with the open high low close bar chart, the vertical line is just the height of the low. Okay, the left tick is the open, the right tick is the close. So you can see the line, that's the high of the day, that's the low of the day. The left tick is the opening price, the right tick is the close price. Now, this is actually very similar to the candlestick chart pattern, and you use it in a very similar way. Some institutional traders do prefer this chart pattern. It is good as well for precise visual analysis, but I think it's just slightly less intuitive for traders, especially for new traders. Offers the same data as candles, it's just presented as differently. So basically, the candlestick chart and the bar chart are showing you virtually an identical thing. It's just I think that the candlestick chart is more intuitive than the bar chart, but you can essentially use them interchangeably. Another option is a line chart. Now, this is quite straightforward. This plots only the close for each period, and it connects the dot with a line, right? So that was the close on Monday the 20th of January, one dot. 27th of January, that was the close, another dot, and then the two dots are joined. That was the close on Monday the 10th of February. At that price, 407, another line. So very good for long-term investors. If you just want to see a broad trend, you want to remove all the noise, then this is a great pattern to use. It's not suitable for intraday trading though, or detailed entry planning, because it's too, you don't see that, you don't see that range of move. You just simply get the close plotted and lined up. So if you wanted to have that made really clear, just put the markers in, and the marker that, okay, it was closed there, that was the close for that week, 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 and then the lines are all joined. So very good for long-term investors. Another chart to use is the area chart. Now, the area chart, it is the same as the line chart. You get the close only, right, that are joined up, but the area underneath has a fill. So it kind of visually emphasizes the magnitude of price movement, and some people like it. It's nice for charting, presenting, just good for portfolio dashboards, things like that, macro overviews. It's a bit more visually engaging, but it's not really telling you anything different to the line chart. Now the next candlestick is again a little bit different. Now this is the Heikan Ashi. Now this is a very interesting pattern and way of visualizing the price. What it does, it's calculated the close is the open plus the high plus the low plus the close divided by 4. That becomes the close price. And the open for the next day is the previous Heikan Ashi's candles open plus the close price divided by 2. And the high is the max of the high open or close, and the low is the minimum of the low open or close. So if you look at this compared to, say, a candlestick chart like this, now see it's very similar here, but if you actually look at the Heikan Ashi chart, what it's very good for visualizing is when a trend is in place. So it does help reduce noise, and you can see that when the Heikan Ashi is green, that you've got a clear uptrend in place. Clear uptrend in place. So if you've got a market and you're expecting it to go from a bearish trend to an uptrend, and you want an entry point, this is a great chart pattern to use. Say Microsoft it's in a downtrend. You're thinking, I'm expecting this to pick up. Okay, when am I going to get back into the uptrend? I think, okay, here's the first evidence that it's turning green. I'll enter there, stop underneath that. Okay, stopped out. Okay, here's another opportunity, entered again, stopped out, and then entered again, stopped out. But then finally, okay, entered again, I got into the move. So this is good when you want to get into a clear trend and you're expecting the trend to develop, but you want a little bit of help timing it. Now, the downside of this is it's not good for precision entries, because this isn't reflecting actual market prices. It's all to do with the previous candles open and close divided by a certain number. So it doesn't reflect the exact actual market prices. So it's not good for scalping at all. It's not good for precision entries, no, but it does give you a good indication of when the trend is changing. So that's what I would use the Heikan Ashi for. Now, here's a different chart pattern, and this is the Renko chart pattern. Now this, the way this calculated, it only forms a new brick here when price moves a certain amount. So let me just put this here. Okay, I used a traditional box size 5. So in other words, when price changes by $5, you get a new brick. $5 move, new brick. $5 move, new brick, new brick, new brick, new brick. Right? So again, very good for trend clarity. And you can change the brick size. So if you wanted to have, okay, I only want to see a new brick when there's $10 of price movement. Okay, there we go. So that's $10 of price movement, new brick, new brick, new brick. Excellent. You see how that visualizes the chart in a totally different way. Great for trend clarity, and very good for just filtering out sideways chop okay? But it's not ideal for time-based because you can see that the time it takes to travel those $10 will vary. Sometimes it moves through quickly, sometimes it takes more time. So it does help set very clean stop loss levels. So you can see here, if you're thinking, okay, then the trend is underway, 391, I have my stops under 359. Then you go to the candlestick chart. You can see here, okay, 391, stops here. Very nice, very smooth move. So do like it for the clarity that you see in a trend. Now the final example is the point and figure charts. Now, in a way, they're similar to Renko's, in that whenever price moves up by a set amount, you put in the X. So you can use your box size, you change the size, how many dollars move up you want, right? So obviously, the greater the size of the box, then you're only going to get an X when price has moved up a certain amount, and also you only get a 0 when price moves down that set amount. Again, there's no time component, you're just looking at price. Excellent for identifying, people get into this, particularly for identifying breakouts, patterns, support and resistance, and people can also use it for intraday technical analysis. I haven't spent a lot of time on this pattern, this chart pattern, and it has kind of a little bit of a cult following amongst some certain technical analysts, especially classical technical analysts. I don't think it provides a lot of obvious help on a superficial usage. I think the benefit would likely come from a deep dive into how to use it. It does require practice as well, and it's less popular with retail traders, and it's not something that I've used a lot, but nevertheless, there it is. So, folks, there you go. The question you're going to be asking yourself now, well, which chart is the best? Well, it really does depend on your trading style. I prefer candlestick chart patterns. That's what I've spent my career focusing on, and I think they offer a nice blend of being understandable, being able to also limit risk, and they're also quite accessible. Every chart pattern does offer a kind of a different lens, a different way of seeing the same price, and the key is just choosing the tool that amplifies your edge. Not just what looks cool, or I like that, I could see myself doing that. Think what style of chart pattern best suits your style of trading. Try each style, understand what it shows, what it hides, because the better you read the chart, the better you can read the market, and ultimately that's going to help you with your chart pattern recognition, especially if you're intraday trading or you're swing trading. Understanding how the charts are displayed is really crucial for that endeavor. The very heart of technical analysis is to find a trend and ride it to the end. That's all very good in principle. However, many beginner traders in particular really struggle with this concept of what is a trend. Now, the irony is it's actually quite simple, and if you spoke to a preteen or someone who was 7, 8, 9 years old, they wouldn't have a difficulty finding a trend. But as we sort of develop, we start to think, well, what is the trend? Is it a trend on this time frame or that time frame? What is the trend? So the whole idea of this lesson is just to try to anchor us in easily understanding what a trend is. And so what I've decided to do is to go back to the founder of technical analysis, that's Charles Dow. And what I want to do is just explain his principle for defining a trend. And I think once he actually explains it very well, and in a way that's quite unique. So I hope this is going to help. And once you've listened to this lesson, you'll understand what a trend is, and you should be seeing it through the right lens. So without further ado, let's start the lesson. Now, lots of technical analysis around today can be traced back to the work of this man, Charles Dow. He is one of the founders of the Dow Jones and Company and the original editor of the Wall Street Journal. And in 1884, Dow published the first version of a stock market average based on the closing prices of 11 companies. Now, 9 of these companies were railroads and 2 were industrial firms. And at the time, Dow believed that these companies, at the time he was living in, gave a very useful snapshot of the state of the whole US economy at the time. By 1897, this had changed into 2 separate indices. There was a 12 stock industrial average and a 20 stock rail index. And by 1928, the industrial average grew to include 30 different stocks, which is what we know today as the Dow Jones Industrial Average, the Dow 30, right? So what can traders use today? Now, Dow Jones and the original work was aimed at long-term investors. It was those who were trying to catch major trends that might last for years. Now, that's not always helpful for swing traders or anyone looking to hold trades for just a few days or few weeks. So in this lesson, what we're going to do is we're going to take what's useful from Dow's framework, and then you can use it to apply it to the kind of trading you may be doing if it's swing trading on a smaller time frame. We'll use his concept of trend structure and layering to understand how smaller market moves fit into this larger market cycle. I think that's the best way for us to do it. And Dow Jones had these 6 principles here. And the first principle I want to really draw our attention into is he considered that the market had 3 distinct trends. And the way he described it, I think, it is very helpful. He saw it as a primary, secondary, and minor trend, right? And then he used a very helpful way to describe this. Essentially, he described the primary trend like the tide at the beach. So he's saying that if each wave progressively reached higher up on the shore than the last, then the tide is coming in. You know, a wave comes in, goes back, and then, in the next couple of minutes, it's gone a bit further up, and then a bit further up. So what Dow said is, if that tide is coming in and the waves are going up the beach, the market's primary trend is rising. Now, if each wave falls shorter than the last, then the primary tide is going out, right? So Dow believed that these so-called primary trends could last for a year or more, and they represent the major direction of the market. That's the big cycle, okay? The bull markets and the bear markets. He then saw a secondary trend going on. And the next layer down is what Dow called the secondary trend, and he compares it to waves within the tide, right? These are kind of corrective moves that Dow considered to last between 3 weeks and 3 months. So they can move against the primary trend. They're essentially pullbacks. So, the trend is definitely going up, right? And then there's a pullback that can last between 3 weeks to 3 months. They move against the primary trend. They're pullbacks in an uptrend, they're rallies in a downtrend. Now, the final aspect, he saw there was minor trends, which he refers to as ripples, right? These are the smallest, shortest term moves in the market and usually last for a few days or up to 3 weeks in Dow's theory. And these are the moves swing traders often focus on. But they always sit, remember, within the context of the larger waves and the primary tide. Right? So I think that's a very helpful way to see it, that the primary tide is when you just pull up a daily or a weekly chart, and what direction is it going in? Up or down, right? Or is it, range bound? It's quite simple. You can pull up a chart. Oh, is it going up on the weekly and the daily chart? Then the primary trend is clearly up. Is it going down? Then the primary trend is clearly down. That is how simple it is. And then that is your primary tide. And then you can look at the secondary waves, the pullbacks and the ripples, etc., etc. Now, Dow also believed, which is helpful, that a major trend, he considered it had 3 distinct phases. So the first distinct phase was the accumulation phase. Right? He considered this accumulation phase to be when the smart money begins buying. This is when the market's still likely full of bad news. Sentiment is probably really low, and everyone's talking about how bad this market is. But quietly, smart money begins buying. Okay, and this is, you often see this when the narrative is terrible and everyone's sort of selling a stock. There's some sometimes smart investment strategies that are taking another look at it and saying, actually, all the news is priced in, and there's actually a market phenomena. If there's something will no longer go down on bad news, then it's kind of a good indication that the bottom is in. But that's for another lesson. The second phase he considers the public participation phase. This is when the trend becomes more visible, right? News starts to improve, charts start to break out, and more traders, more institutions begin to enter. It suddenly becomes a growing tide of popularity. Finally, this is the distribution phase. This is when those early buyers start to quietly sell into strength, right? The public's still buying, but the trend is matured now. Now, understanding these phases help traders spot where we are in a trend and prepare for what comes next. Now, Dow theory is good, and there's a lot of merit in it, which is why I wanted to share it with you. But remember, it's mainly applied to longer term trading, which is fine. Maybe you're taking this course and you're thinking, yeah, I'm looking to trade these sort of 1 year, 2 year trends. Great. Dow theory is excellent and will serve you well, even if you're just taking that primary trend, the tide, the waves, the ripples. That concept alone, I think, is helpful. But if you are looking at a slightly smaller time frame, let me begin to break this down. Remember this aspect here. So an uptrend is basically a price movement where each successive rally closes higher than the previous rally high. Okay, so it goes up, pull back, new high, pull back, new high, just like on this chart. Each successive rally closes higher than the previous rally. It's a clear and obvious uptrend, right? Rising peaks and rising troughs. The other way you hear people describe it, higher high, higher low. Higher high, higher low. Higher high, higher low. It's a series of higher highs and higher lows. Simple, right? A downtrend is the exact opposite, but it's the price movement where each successive rally closes lower than the previous rally low. So in other words, new low, right? Lower high, lower low, lower high, lower low, just like this. It's this stepping kind of formation. That's very characteristic of a downtrend. And there's all sorts of theories and different technical ways of looking at this. You could be using Elliott wave theory. You could just be using a simple trend line. But the bottom line is that it's really explaining the same kind of phenomena. But I think Dow theory, in principle, is the best way to look at it. Then, falling peaks and troughs. Then this is where it's important, because this is what Dow believed, is that a trend is in effect until it signals a reversal, right? Signals a reversal. So here's the question, how do you find a reversal? Now this is important. And I'm going to give you 2 ways of finding a reversal in swing chart trading. Now, so first of all, the first reversal is called a failure swing. Do you see the price on the left? It's making higher high, higher low, higher high at point A. Then you've got a higher low at point C, but point B, sorry, right? You've got that higher low at point B. So at point B, the uptrend is still very much in play. It's an uptrend. Then look at point C. Now what do you see? You've made a lower high. And then look what happens as price breaks down through B. You're now making a lower low. That's the first evidence that the uptrend has failed, because you've got price breaking down and closing through point B. Now in real world market dynamics, this is just like a really clean example of a failure swing, but sometimes you'll get a test of B and it won't quite close underneath. So look for, like, if you're using these failure swings, look like for a close on a daily level. And then sometimes there'll be a big support level that it's a false break and then it carries up. But you know, the real world is not as straightforward as it is on the charts like this. But this is the principle, okay? And you have to interpret it based on, you know, market dynamics, macroeconomics, etc., etc. But the principle is sound. You know, this is a failure swing. When you've got that point B being broken, that shows you the uptrend has now broken. I like to use trend line breaks to show me the beginning of a trend. I think it's the earliest potential signal of a trend line break. This is another example where you have a trend change, and probably more reliable because you've actually got a swing that's failed. So this is reliable to use as okay, the trend has changed. So that's the failure swing. So recognize that kind of pattern. Then there's something else called a non-failure swing. It's a little bit more complicated. Now, if you notice, you've got an uptrend to the left of the chart, right? Higher high, higher low. Higher high at A, higher low at B. Higher high at C, right? Now, there are two different opinions here, and you have to decide which one you want. Do you see the line from C to D? Do you see how the line C to D has broken that B point at S1? Right, now some analysts would say that is a change of trend. But other analysts would say, well, hang on, C made a higher high. So there's no guarantee that D to E won't go up even higher than C. So some analysts would say, no, that's not quite a change of trend yet. And that could still work out being a higher high. That's how some people would look at it. And what they'd say is they'd only say it's a change of trend at S2, when you've had a lower low, lower high, and then E to F, another lower low. And it's that point at S2 where some analysts would say that's where the trend has changed. So just compare these two and understand what's going on. The key to understanding it is this is a failure swing because B to C wasn't a new high. This is a non-failure swing because B to C was a new high, but price still broke down. Do you see? Both of them can be considered a change of trend. But with this one, some analysts would say S2 is the change of trend. With this one, it's the price breaking down through B is considered the change of trend. Really, it just comes down to your preference. It comes down to what you prefer. There isn't per se a right or wrong answer to this, and I don't know what the back testing information is for this, and even if it was there, it would be quite hard to correctly analyze. But either way, either approach is pretty sound, okay, and will give you a good basic framework within which to see the whole market. Now, trend trading is very important, and trying to ride trends for as long as you can is where most of the profit is found. So understanding at what point the trend starts, stops, finishes is important. And like my best trades over my career have been trades, very simple entries, right? Usually there's a macro story that develops. Is it like, okay, silver's expected to break out, gold's expected to make new highs, Bitcoin suddenly becomes no longer a sort of rogue investment. All of a sudden, there's main institutions buying Bitcoin. Those big stories, and then you say, well, hang on, okay, I'm now convinced that this instrument is likely to go up. And then using trend line breaks on weekly or monthly charts, they have been my best trades, because you're getting into that trend as early as possible, and you're defining and limiting your risk, and you've got this high probability that price is going to keep move higher. So I'd say, in stock trading, you want to look for the same kind of thing. I remember, was it like 2024 when Warren Buffett started buying Japanese stocks, right? A simple trend line break, great. It was dead easy. There was a nice weekly trend line. Close above it on the weekly chart, go with the trade. You could run your stops just the other side of that trend line, or the other side of I think there was a symmetrical triangle pattern when I remember back. Simple is the honest truth. It wasn't complicated, and some of my best trades, and this might just be because of my background as a macro analyst, have been those longer term trades. So if you're watching this and maybe you got a full-time job, and you're thinking, oh, I can't spend all my time, in the markets. Honestly, you don't need to. Even if you did, just stay in touch with what's being spoken about in the financial media. Read, Bloomberg.com, and all of a sudden something will jump out to you. So you think, well, hang on, that looks a really interesting instrument to trade, and you do a bit of more research and go, oh yeah, that is good, and then just look for a very simple trend line break. They're the simplest trades, and I think Dow theory will serve you well as a way of sort of understanding that from a technical analysis perspective. And he is kind of the founder of technical analysis as well. So I think you're going back to the roots there. Now in this section, I'm going to point out to you some really useful reversal candlestick patterns. I'm going to point out to you 2 single bar patterns and 1 multi-bar pattern. They're going to be the hammer reversal, engulfing bars, and the morning and evening star. So before we start, it's worth saying that candlestick pattern analysis is a huge topic in and of itself. You could take this whole course just looking at candlesticks. So what I've done is I've pressed the information as to what I believe is the most useful for stock trading in particular. And if you want any more further reading to do on candlestick patterns, individual patterns beyond the scope of what I'm providing here, can I recommend the CMT curriculum. Now you don't have to enroll to take the exam. You can get hold of a relatively cheap CMT level 1 or level 2 curriculum that has some fantastic candlestick analysis in it. So if you would like to learn more about candlesticks, get a CMT level 1 or level 2 curriculum. It doesn't need to be in the most up-to-date year. You can get a recent year, or even 3, 4, 5 years. It won't really matter because it's the same material. They don't update the candlestick analysis all the time, and you get some fantastic resources there for a relatively cheap back copy of the CMT level 1 or level 2 that you can get hold of. So that's just worth saying as we get started into the session. And I'll just put my book down, and then we can start to look now at some of these reversal candlestick patterns. So the first one I want to point out to you is the hammer reversal. It's a single candlestick pattern, and I'm going to show you what you want to look out for. Here is the S&P 500. This is the weekly chart, and you can see on this chart there's a few really good hammer reversal patterns here. So if you look at this pattern here, what you're looking for with a hammer reversal is it's a single bar pattern that highlights that the price is about to reverse. So if you think about it intraday, price is moving lower, 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 it snaps back higher, and then you have a bullish close. Now what you're looking for ideally, there's some things that I've learned through a lot of experience, which is the tail. This is the basic stuff first. The tail needs to be twice the size of the body. So you can see here the body's twice the size, the tail's twice the size of the body. Do you see how it punches into this space. If you look to the left hand, see there's that space there. That makes it more powerful, the pattern, because it's rejected all this area. For intraday, sellers thought they were breaking out of these swing lows, and they thought, and look, they snapped back higher. So all those sellers there having to reverse their position, they tried to go short, and everyone who sold down here is at a loss, and so they're more likely to exit their positions, and then that in itself can propel price higher. And also, do you see how the volume is just slightly rising? So you've got volume rising. If you look at the average true range, you can see that's just picking up. So you've got volume rising, average true range rising, and then you've got this nice reversal pattern. Similarly here, hammer reversal. It doesn't necessarily matter whether the body is bullish or bearish. I think it adds a little bit of edge if you have the body close within the body of the previous candle. So you see that is not as strong as this pattern because that body hasn't closed within the body of the previous candle, whereas that body has closed within the body of that previous candle. You've got space to the left, but space to the left with this one, that's great. But what you have got here is, look, volume is definitely picking up, and you've definitely got the average true range moving. So you've got volume confirming that. Similarly with these reversal hammer bars here, look, long tails, twice the size of the body, body closing within the body of the previous candle. You've got good support of the 200 exponential moving average, and you got average true range pushing up, volume pushing up, just confirming that kind of reversal. So look out for hammer reversals. The opposite of a hammer reversal is the evening shooting star, rather. It's called the shooting star, and a shooting star is literally the opposite of the hammer reversal. So let me try and find you one here that's nice to see. See, there's a shooting star, and you can see price is moved up. You've got the candlestick, the tail is twice the size of the body, small body, and you see how volume is falling, average true range falling. So if you look at that, you think, okay, volume's falling, average true range is falling. That could be preceding a reversal. So decent pattern to look out for, and definitely ones not to miss. So it's a hammer reversal or a shooting star individual pattern. They're two single candlesticks. Another single candlestick pattern to be looking for is this one, a bullish engulfing bar. Now you can see here, you've got this bar engulfs all the previous week's price action. So if you think about it psychologically, sellers thought they were taking price lower. They got caught out. Buyers were able to take price above the high of that previous week's candle, and all those sellers have got totally flushed out. And notice you've got 1, 2, 3, 4, 5 whole weeks of price trapped by this one engulfing bar. And also, do you see it's from key support at the 100 exponential moving average? We'll cover this later, but you're adding up different parts of the jigsaw here. Bullish engulfing bar, key support level, the 100 exponential moving average, and look, you've got the average true range picking up. So everything is pointing towards higher prices there. It's a nice bullish engulfing bar from a key support. Single candlestick. The key thing is you want the open to be below the low of the previous candle and the close to be above the high of the previous candle. That's the bullish engulfing bar. And here's a bearish engulfing bar. You have exactly the same, but in reverse. You can see here, look, volume falling, ATR falling. You've got bullish engulfing bar resistance level, price moves up to that overhead resistance, sells off sharply, and you can see it shells off 1, 2 previous days of price, completely engulfed by that bar, and that precedes a move lower. So that's what you're looking for. You're looking for these as reversal signals, things that show that price is going to reverse, ideally from a swing point. Now another 3 candlestick pattern that you need to be aware of is the morning and the evening star pattern. Now these are great reversal patterns, really important to look for. So with the morning star pattern, you want to see a downtrend, solid black candle, right, for the morning star, and then you want to see this as though sellers I've come here on the next week and they're acting like they're going to take price even lower. It looks like sellers are completely in control. But they've even closed below that swing point. It looks like they're completely in control. But then look what happens the following day. Buyers come in and they close well into the body of that first candle. So it needs to be a 3 candlestick pattern. You have the downward candle, a key reversal area, this kind of abandoned kind of baby, it's just there on its own, gapped away and left, and then ideally the next candle gaps back up higher, and that's just left on its own. And then the trigger, the early trigger, is going long from the break of this candle, stops underneath the low, or going long once you have a confirmed break above this candle. So they're the two sort of ways you could enter this. So it would be like this. That would be one option. And then you could target just the overhead resistance. That, or a more aggressive entry would be here. It stops just under there, looking for a move up to that level there. So that's the morning star. The evening star is just exactly the same, but in reverse. Let's see, I think I had an evening star here. Yeah, here it is. Right. So you got price rapidly moving higher. Price shoots up. Then look how it gaps up higher, as though price is wanting to make fresh highs. And then look, the following week, price gaps lower. And you see how it's kind of left on its own, almost like an abandoned baby or up there on its own. And then you have a close within the body of that previous candle, and that is the trigger to go short, with that level being taken out. And then you can see price just moved sharply lower. So these are very strong reversal patterns to be looking out for. They're ones not to miss. Let's just summarize them for you. You want the hammer reversal, which is when you got it from these swing points. Hammer reversal, and it's moving higher. We looked at some fantastic examples here. Hammer reversal, rising volume, rising ATR, rising volume, rising ATR, great hammer reversals. The opposite was the shooting star, and that's when you see price just here. You can see, good example here, the shooting star moves up, long tail, twice the size of the body, space to that side, volume moving, ATR falling, then proceeds a drop. Bullish engulfing bar from key support, the bearish engulfing bar from resistance, and then the evening star and the morning star. They are 3 great reversal candlestick patterns that you need to look for, and look for them to be confirmed with volume, with the average true range. I cover this later on in the course, but I want you to begin to become familiar with those concepts and the idea of getting confirmation and using candlestick patterns in line with reading the chart as a whole. This lesson is a very important one. Support and resistance, what is it? Now, this concept of support and resistance is probably the most fundamental tool in trading, whether you're trading stocks, Forex, crypto, or futures. Understanding support and resistance helps you spot turning points, plan trades, and manage risk like a professional. Now, what is support and what is resistance? Support is simply a price level where demand tends to show up. Right? It's where price literally stops falling and buyers step in. Similarly, resistance is the opposite. It's the level where selling pressure kicks in and price struggles to rise further. Let me just show you on the chart here. If you look, I got the SPY ETF. It's an ETF for the S&P 500, so a very liquid, heavily traded ETF. And you can see here, right, there's these key levels. There's this level, which price doesn't seem to want to go higher than. And there's this level, where price doesn't seem to want to go lower than. So obviously, you can see you've got a resistance level here, which is stopping price moving higher. and you've got a support level here, which is preventing price moving lower. Now, these levels aren't random. They form because traders remember past price reactions. And institutions often cluster large orders at these zones. Now, think of them like zones, not like lines, think of them like zones. We'll cover this more in the next lesson. But just remember, these are like psychological walls. So this is like a floor. Remember, it supports price from falling. This is like a ceiling. It prevents price from moving upward. So why is it that these levels are so important? It's because price reacts around them. That's why they're so important. And you'll often see, right, big reversals, breakouts, pullbacks, right at these kinds of levels. They're a really critical part of price structure. Now, they don't just appear at random places, and they don't just appear as flat lines either. You can also have support and resistance as moving averages. So you can see here, this is the 200 moving average. Notice how the 200 moving average provides support here on the 31st of May 2019, here and here. And these are not just cherry-picked examples. This happens all the time. You can see the 100 exponential moving average support there and there, nearly there, 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 and then providing resistance, resistance, resistance. So support and resistance levels, they're not just straight lines, they're not just straight zones, they can also be Fibonacci points. So if you took at this Fibonacci retracement here, right, you can see, oh look, the 61 area reacted as a resistance level here and here. And you can see, oh look, actually, that 61 fib retracement level, that was a floor, and when the floor breaks, it then becomes a ceiling. And often you'll see these roles reverse all the time. What was a floor can suddenly become a ceiling. So if you look here, you can see these lows here. Support, 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 breaks. That old floor becomes what? Becomes a new ceiling. So this role reversal level, it happens all the time. It's such a common phenomena. You'll see it all the time. You can see here, okay, resistance, resistance, right? Ceiling, 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 and look, the old ceiling becomes a new floor area. Exactly the same. Ceiling, breaks, and then it kind of reacts as a floor level. You can see this sort of temporary ceiling into price here. Temporary ceiling, it breaks, becomes a new floor. So how can you tell if a level's really strong? Well, one of the ways to tell if a level's really strong is if you see a big spike in volume when price moves back into the support level. So you can see here, this was this temporary short term, it was a swing high, so it becomes a decent resistance level. Resistant, then it breaks, and then this support level holds, and look how it's confirmed by the really high volume. Price moves down, really high volume, and that acts as brilliant support. So one of the ways you can validate, a support level is on high volume. You can see here, look at this, right? Resistance, breaks, pulls back, support, support on high volume, right? And that validates that support level. So the ways to, use it, support and resistance, don't think of it like lines. You could just draw it very strictly as a line, but you'll find that you'll create problems for yourself because here you see, you think, okay, that's a line, but what about here? What about here? Nearly touched it, but think of it more like a zone. We'll cover that. I think of them support and resistance zones. That's a better way to look at them, and it's more helpful to see them like that. Here's another example here. You can see that becomes a resistance level, that swing point, and you just put in the horizontal line. See there? And price breaks above, and that old resistance, do you see how it was support, breaks, becomes resistance, and then look at that, breaks, and then becomes support. It's no coincidence that that's a very important level. Yeah, and so you can, and then you get the pullback, and you get the rejection as prices pushes away from that. So you buy at support, right, and you sell at resistance. If it's breakout trading, you can just wait for price to break through a level and close above it, and you can enter them with a tight stop. So here you can say, okay, we've broken above this resistance zone. Okay, I'll stay with it. Stops can be just very tight the other side of the pattern. And also, these are great areas for targeting buying or selling. So let's say, for instance, let's say you're long from this 576 area, and you're looking at a logical place to take profit. Well, up at this resistance level, so anywhere around the 600 would be a perfect area to take profit. So support and resistance levels, they're not just lines on a chart, right? They reflect real human behavior, institutional order flow, and whether you're trading breakouts, role reversals, whether you're trading support and resistance on the Fibonacci retracements or on moving averages, support and resistance are where buyers reveal their intention, okay? And in the next lesson, we'll be looking at more how to mark them and use them, and I'll give you a few tips from my time in the market to help you use them. So without further ado, let's jump on to that next lesson. In this lesson, I'm going to show you how to mark support and resistance levels, how to use them when they're more significant, and I'm going to show you an area where traders often go wrong in marking these levels and help you think about them in a different way. So without further ado, let's jump onto the charts. Now, I've got in front of me a NVIDIA chart. I just want to show you dynamically how you mark support and resistance levels in. Now, the first mistake that people make when they think of support and resistance levels is they see them as lines rather than zones. So let me give you an example. So you see here, you've got this swing high in the video on May the 30th. Price pulls back. Now that level becomes very significant, and that is a near-term resistance level. Now you might think, is the resistance level there at the top of the wick of the candle, right? Or, is the resistance level here at the body of the candle, or is it at the bottom of the candle? Is that a better level to look at for the support resistance level that we've got marked there? Don't think of it like that. Think of support and resistance not as a line, but as a zone. So instead of marking it like that, it's going to help you if you mark the support and resistance zone like that. Okay. Now it's not perfect, right? And this is a good example because it's not perfect, like real life. But it shows you that zone area is an important resistance zone. Now think of a support or resistance zone like this. When you're trying to push your hand into your stomach, this is the best way I've heard explaining it. Initially, there's some fat in your stomach as you push into it, but eventually there reaches a point where you can't push any further. You've reached the kind of final part of your body. That's the same way that support and resistance levels work. You might push into resistance and you can push and push and push, but there's a point which you can't push any further and you sort of snap back. So that's the way to think of support and resistance levels, like these zones. And when you think of it like that, they do make a lot more sense. So let's go back to the chart, and you can see here, okay, that is that level, that support, that resistance. Once it breaks, do you see it breaks higher? And that becomes a support level. So the resistance initially becomes ceiling, but then it becomes a floor, right? So the ceiling becomes a floor. So once resistance is broken, it becomes support. Similarly, look at this resistance here, right? Okay, another swing point on June the 23rd, right? Prices pull back, breaks out, and that ceiling, that zone, now becomes a floor. A floor, but then look, the floor breaks, and then that old floor becomes a new ceiling. And that's the way that support and resistance zones work. They constantly alternate between being a ceiling that caps price and a floor that supports price. And the more times that support holds, the more reliable it is. So the more time a level is tested without it breaking, the more reliable it becomes. So multiple tests give the support resistance level more validation. Now, the other thing to notice is that volume confirms validity. So let me give you a good example of this here. Okay, so we can see here we've got a swing high on the 23rd of August, swing high on the 21st of November, and a swing high on the 18th of December 2023. That is a hugely important line. Okay, hugely important resistance level, and we can mark that here like that. All right, so you've got ceiling, ceiling, ceiling. But look, do you see how the ceiling breaks there? And do you see how it breaks on rising volume? When you see a resistance level breaking on rising volume, that's a really good indicator that that breakout is going to last. So that means breakout buyers can just have their stops the other side of that old ceiling. So that old ceiling becomes a new floor, and you can just keep your stops under that level. And you can see that volume is pushing higher. And you could also see, look, previously price hit the 100 exponential moving average, dynamic support, price moved higher, hit the 100 exponential moving average again, dynamic support, moved higher. We'll look at moving averages when we get to that section. But that's the dynamic support aspect of it. You see the moving averages changes, but it provides that dynamic support. And you can see all the way as you go through, this support and resistance principle keeps working all the time. Okay, so the swing point here from the February 12th, right? Ceiling. Old ceiling becomes a new floor. And you notice, it's no coincidence that then when price comes back down to this level here, that old ceiling becomes the new floor. And then again, you get another breakout. You've got this swing point here and here and here. And then look, what do we see? Oh, look, price breaks out of that resistance on volume, and that's confirming the break. So key things to be aware of: treat support and resistance levels as zones, not lines. Strong support and resistance levels are often confirmed by multiple touches. Okay, so when you see multiple touches, that's confirmation. Also, note that the higher the time frame, the more important the level. So on the weekly chart, for instance, you can see that these levels are clearly very, very important that we've got marked here, right? You can see how important that level there, look, that zone, held here, held here, held here, hugely important zone. So you can see here in the video that sort of 80-90 support level that then is in line with the 200 exponential moving average. And when you have multiple layers coming together, you've got this horizontal support, you've got a long-term moving average, you've got that test, and then, oh look, you've got a bullish engulfing bar, a nearly bullish engulfing bar rather, I should say. Certainly a strong rejection candle. That's actually a bullish piercing line candle, actually. So that is a strong confirmation that that level is going to hold. So in an uptrend, right? So say you were buying from here, the overhead resistance becomes a target. So if you were buying from these support levels, support, you buy from there, overhead resistance becomes target, support, the overhead resistance becomes target, support, the overhead resistance becomes a target. In downtrends, when price is moving lower, the previous support becomes a target. Price doesn't just like smashing through these levels. It's a little bit unusual with Nvidia because it's been in such a strong bull market, but usually you see traders taking profit as you hit these overhead resistance levels. Traders taking profit if they're selling as they hit key support levels, and they tend to operate as decent targets. So that's the key thing to be aware of, using volume to confirm the breakout. And the other thing to be aware of, and this is an important point, is the daily close above a support and resistance line is very important. Now, there is a bit of a grey area, okay, when sometimes, having said, think of support and resistance as a zone and not a line, there comes a point where there's a bit of a grey area where you've got this sort of trend line here. And a trend line you want to have as a line just touching price. But when you get a break and a close above a trend line like that, then that is a very, very important signal when you have a break and a close on the daily chart. So look for that. If there's a big support resistance level and you're thinking, will it break? Will it not break? Then see, do you get a bullish close above the level or a bearish close below the level? And is it supported by volume? If it is, that's much more likely to be a legitimate breakout than one that breaks out on low volume or little volume, and especially one that just pierces without breaking out of the level. You know, that's a good indication that prices are not confidently finding buyers above the breakout level. So support and resistance, the key thing, I'll give a little handout with this so you can see the key principles. The most important thing to realize is, you know, support and resistance, it's not a line, it's a zone. And when you start thinking of it like a zone, it makes it much easier to recognize the levels, to realize that, okay, swing point, support, support, support. And you can see here, okay, you know, price broke down through that support level and was a false break. And you can quickly see that's a false break of that support level. And that just gives you a little bit more determination and a little bit more anchoring that that's a decent support level. When you can see here, price breaks higher above the 100 exponential moving average and carries on its way. In this lesson, I'm going to show you what a trend line is and, crucially, how to use it well. Now, don't make the mistake of thinking trend lines are too simple or beneath you. Trend lines remain one of my most reliable technical analysis tools. They're simple, they're straightforward, and they can provide great ways of getting into strong narratives in a simple, easy way that can manage risk very neatly. So, first of all, what is a trend line? Now, a trend line is really very simple to analyze, and it won't take you long to recognize them. It's probably just worth me saying at this point, what I'm going to do is I'm going to point out to you the orthodox understanding of a trend line, and I'm going to show you an unorthodox way of using a trend line that just works through experience. So you'll see, I'll teach you the orthodox method first so you can see exactly what a trend line is, and then we can go into the unorthodox method that is used by other analysts as well. It's not just completely unique to me, but you'll find it bears out through experience. More on that later as we get through the lesson. So what is a trend line? Very, very simply, a trend line is just a straight line drawn upward that is connecting a series of higher lows. Can you see this? Point 1, buyers step in. Price pulls back. Point 3, buyers are stepping in at higher prices. Point 4, there's new higher highs. Point 5, buyers are stepping in at even higher prices. You draw the line through those swing points, and that is your uptrend. Very, very simple. Now, a downtrend is exactly the opposite of the uptrend. It's just a straight line drawn downwards across the tops of a series of reaction highs, as shown by points 1, 3, 5. Now, this helps define a downtrend, okay? where each bounce fails to break higher than the last, and then you draw a line through those successive points, and then you have your downtrend. Simple. Now, this is where it gets interesting, because the orthodox understanding of the confirmed trend line is this, right? Now, in a textbook uptrend, a trend line is only confirmed once it touches at least 3 points. So you see the first 2 points define the line. 1 and 3, right? That's the line. But it's only confirmed at point 5. So once the market pulls back to that trend line and respects it, you now have a confirmed uptrend. Now what that means is that points 5 and 7 become positions where traders can add to long positions. So 1 and 3 in the orthodox method is define the trend line. Point 5 is where the trend line is confirmed. You see that? Right. Then point 5 and 7, you can consider adding long positions. Right. Very simple. And with a downtrend, exactly the same. Point 1 and 3 define the downtrend. Point 5 confirm the downtrend. And point 5 and 7 is where you could consider adding shorts to that position. Now, here's the really helpful part, right? Is how do you spot an early reversal? Now, according to classical trendline theory, and this is played out in my experience as well, point 9, see where point 9 breaks through that trend line? That's often the most reliable early signal that the trend is potentially reversing. At that point, the market is no longer respecting the trend line, and something might be shifting beneath the surface, right? So, being aware of that, you can help tighten risk, take profits, or prepare for a counter trend opportunity. Do you see point 9? Point 9, often the earliest point. And often what I've noticed, if you see point 9, do you see how this ties in with the failure swing and the swing method of defining a trend? If you just go back at this point and have a look at module 4 and lesson 2, defining a trend, you'll see how this ties in with failure swing and a non-failure swing. Often these concepts overlap, and this is a clear example. So once you have that break, and usually, imagine this was a daily chart, you'd be looking for a daily close underneath that level. And that would be your first indication that the trend has changed. Here, the first indication that the trend has changed. Now, there's the tentative trend line, and there's the confirmed trend line. So what I've taught you is the orthodox method. That is kind of like the correct method, right? That's the confirmed trend line, and that's how to recognize it. That's how to trade it. That's the confirmed technical analysis way of doing it. But there's also, what I've seen from my experience, the tentative trend line. Now this is where you've just got 2 swing points, but they're such obvious swing points that they become the trend line. I'll show you some examples in a chart, but I use this all the time. And the simple trend line break is a very, very powerful tool. Okay, it really is a powerful way of getting into opportunities, and especially if you're a longer term investor, it can be a really great way of getting into it. The reason this often works is because you can have a strong macro narrative that breaks the trend line. This is going to be best explained through an example. So let me just go back over to the chart. I'm just going to call up a different chart, and I'm going to show you using an ETF exactly how this could be used. It's best worked out like this. So if you look on the chart here, let me just, sorry, my chart is playing up here. There, that's great. There we go. Now take a look here at this XLK. So this is an ETF that represents the technological sector of the US stock market. Okay, so here I've got XLK technology ETF. Great. Now let's start using some trendline analysis on it. Let's say here, okay, we got COVID and we can see there's a terrible time for tech stocks, and you see that you can see price making a successive high that fails, pulls back, successive high that fails, pulls back, successive. Okay, so there we go. So you got 0.1, 0.3, and then 0.5. You've got the downtrend confirmed, and then you've got a potential touch here, 0.7. Then you've got a point here, false break of those lows, and then look, you got your trend line break. Right? So let's say you suddenly thought, well, hang on, I know the Federal Reserve's going to come and help this situation. I think I'm looking for an early point to go long. I want to get back into this. That would be your earliest point there, and you could have entered in long there and just trailed your stop as you went, and you would have seen that could have run a long way up. A very simple trend line break. But then look here, you see what I'm saying about the unconfirmed. That's a confirmed trend. An unconfirmed trend line would be something like this. You got one touch, two touch. Now that's just two touches, right? So it's not a confirmed trend line, but because those points are so obvious, they're so far out, right? 1 point, 2 point. When that breaks, that's essentially a trend line break. Okay, and you can see you can get into this in lots of different ways. So you can look here. Okay, 1, 2. Right, very steep trend. So 1, 2, 0.3, 0.4, 0.5 confirmed. Look, but then it fails. So it's not, don't go looking for every single micro trend. Look for the obvious trends. That's where I find it most helpful. So you can see here, okay, and you can see it's not perfect. Like if you look at this, so 1, 2, 0.3, 0.4, 0.5, uptrend confirmed, 6.7, 0.8, 0.9, more buyers, 0.10, and then a break here, break underneath that trend. But you see that's a false break. So the way people deal with this is sometimes what people will do is, I need to have price move a certain amount underneath the trend line to confirm it. Now, what I find through my experience is what you want to do is you want to look for a clear macro narrative and then use the trend line. So, when you have a clear reason to expect, so say like up at here, for instance, say you were looking, okay, I'm looking for stocks to get exhausted. Right? I'm looking for a very clear, macro break. And then you get one here. Oh no, look, that's a morning star pattern. Nice reversal, false break of that potential trend line. Price moves higher. So then you could say, well, is that confirmed? And you see how it becomes tricky because is that 0.3? Or now that that's underneath, should I move the trend line out? What I find is it's best to move the trend line out to the furthest point. So even though that's kind of a touch, once that's happened, what I find is you move the trend line out to that point. And you see here, look, there's only 2 touches there. But look, that becomes a trend line break. And you see how price is respected and then rejected. Right, that's an important tell there. That tells you what's going on. And then you'll see it's messy because look, you got 1, 2, 1. See here, 1 touch, 2 touch, and you see how that becomes relevant there. Don't forget to use volume studies as well, so you can see, okay, is there a trend line break on volume? So you can see here, trend line break on a little bit of rising volume. See how price is moving up, volume's increasing as it breaks. So don't forget your volume studies, see earlier lessons. But the way this works best is to find that very clear macro narrative, you know, when it's just obvious, you know, what a stock is likely to do, and you're looking for that first opportunity to get in. That's when you want to use those big Mac, and then like the big weekly charts are very good for this as well. You know, if you were just looking, you know, I just want to buy when price, you know, okay, trend line break, go with the long. Okay, trend line break, go with the long. Trend line break, go with the long. Do you see? If you got a market, you think it's just gonna be going one way, just keep going with the trend line break. Trend line break, go with the long. Right, 1, 2. Trend line break. Okay, false break. There we go. Trend line break, go with the long. Trend line break, go with the long. Trend line break, go with the long. Stops underneath the lows. Do you see? Trend line break, go with the long. So if you're thinking, you know, I just want to get involved in this, in the trend line breaks. Look, and there's a nice flag pattern, which is, you know, is that a trend line break? Yes. Is it a flag pattern? Yes. The two together. So I hope you can see how powerful the trend line break is, and they work best when you combine them with a nice clear macro narrative. That way you know the orthodox method and the unorthodox method, both of which are valid, and both of which have their uses in the correct context. Now, a gap happens when a stock opens at a significantly different price than it closed the day before, and that leaves a gap on the chart. It usually signals a strong shift in sentiment, and it can quite often be triggered by a news report. Especially, you'll see this over earnings reports or key macro data. So gap theory is a very important part of stock trading, and there's really 4 main types of gaps. There's a common gap, which is what you get day to day, and this is just often happening in stock markets because they open and close each day. So there's minor discrepancies in price, and you'll get these small gaps. Here's an example of sort of a day-to-day and everyday small gap. If you look here at Tyler Technologies, it's a tech stock out of the US. Just see these days here, you know, your sort of price is sort of moving sideways, and you get these small tiny gaps in the chart here, 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 here. You know, another smaller gap here, another smaller gap there, smaller gap here. You get these sort of small gaps on chart. They're just very common, and especially when they're occurring in a sideways market, they don't particularly mean anything. It's just part of day-to-day business in the stock market. But there's another type of gap that is definitely worth paying attention to, and this is called the breakaway gap. Now, this is when a gap breaks out of a range or a pattern, preferably on strong volume, and this can often mark the start of a new trend. Now, you'll see in module 6, we'll start to look at some key chart patterns. So you might want to revisit this module, this lesson, later on, and recognize that one of the sort of triggers for entering a chart pattern can be this type of gap. It's a breakaway gap. I'm going to show you one very simple example here, but this applies to all chart patterns. So if you take a look here at Apple stock, let's say, for instance, you are looking at this trend line from January 2024 through to April 2024. You notice, okay, it's got 1 touch, 2 touch, 3 touches. that is a legitimate trend line, and you're thinking, I'm expecting Apple stock to turn around, and I'm looking for the first indication that price is going to turn around. And you might say, well, what I'll look for, for a trend line break, moving back above the 100 exponential moving average, in line with the recent moves from February 2023. I'm gonna wait to see if we get a break. And you see here, you've got this large gap here. Now, that's a breakaway gap. It's around 4% movement in price, so it's significant. And you're breaking out of a trend line. So that trend line break means that this has a high probability of being a breakaway gap. It's gapping out of a trend line in this instance, but you could also say, well, it's gapping out of this near-term range. You might have looked at it in a slightly different way and said, look at that range we're in here, from 177 down to the 166. We've got one test, two tests. Oh, look, we've broken away out of that range. And could this be the start of a new trend? Now, the way to set yourself a target for a breakaway gap is like this. What you do is you'd look at the move and say, okay, I think this is a breakaway gap. That's the breakout of this trend line. You think, well, how far, has price moved? So what you'd do, you'd measure the halfway point of that gap. Okay, so here we can see the gap. Right, the gap is approximately 5.18%. So what we look for there, we'll look for the midway point of that gap. So we'll just go to roughly half. We'll do it the other way. We'll just go to roughly half of that. So, 2.5, it's just over 2.5%. Let's say 2.59, right? And that's the half midway point of that gap. Now, what you want to do there, from that midway point of the gap, you want to measure down to the start of the move. And you see here, in this instance, you might say, okay, the beginning of the move higher was from this 164 region. And that now is your measured target higher. So that will be your target. Say you're looking to buy in line with this breakaway gap. You might say, okay, well, I'm going to move here and I've got this, halfway point. Where are we? Here we are. That halfway point. And I want to look for exactly that same move, right? From my entry price, let's say you entered here, and then you've hit target a few days later at that 197. Or you might say, well, I'm going to trail my stop. But that's how you set the targets on those breakaway gaps. You measure from the midway point of the gap down to the start of the move, and then that becomes your reasonable target. Now, where would you put your stop? Well, you just quite simply put your stop the other side of the gap. Okay, so in this instance, if that gap's filled, something's wrong. Okay, something is wrong with the move, and that gap is definitely not a breakaway gap. You're going back into that trend line if you're moving back under that level here. So, you would just run your stops very simply. There's the gap, other side of the trend line, probably for simplicity's sake, underneath that swing point there. So you know that if your stop gets hit there, something is very wrong with the move, and it's not what you thought it would be. Right, that's your breakaway gap. So you can use that for validating head and shoulders patterns, flag patterns, pennant break patterns, symmetrical triangle patterns. That's what you're looking for. It's called the breakaway gap. It gaps out of a range or a pattern, and ideally on big volume. Particularly, you want to see big volume to the upside. You don't need to see big volume necessarily to the downside, but you want to see strong volume on the upside. You haven't got that in this instance here with Apple, but generally that's the best scenario to look for. A breakaway gap on high volume. Now, the next kind of gap is similar to the breakaway gap, but it may not be necessarily breaking out of a pattern. It's something that appears in the middle of a trend as momentum builds. Now, this is really good if there's the stock that's or an industry that's really got major market attention. Think of something like artificial intelligence, or there's some new industry developing, and markets are getting very hyped, and all of a sudden this will often happen on an earnings report or news. There'll be this huge gap on volume in the middle of a trend that's developing. So, and think about it, it's kind of fuel for that momentum to go higher. It's kind of that extra rocket fuel to give that trend another boost to the upside. So here's an example here with NVIDIA. Okay, you can see NVIDIA AI stock really getting lots and lots of hype about artificial intelligence. We knew particularly, during that sort of 2023, 2024, 2025, markets were falling over themselves to get involved, and NVIDIA was one of the big providers of artificial intelligence chip technology, and so there was all this hype around technology. And what you can see here is this, you've got this broad trend higher, and you've got these sort of runaway gaps that are appearing. You can see there's one here and there's one there. And the thing about a runaway gap is that it's not filled. So you can see here, right, price gaps higher. There's a strong trend to the upside, price gaps higher, and then it just keeps moving up and up and up. And again, remember what was your target? Well, okay, you might say that's the midway point of the gap underneath the latest swing, or you might have said midway point of the gap, and you might have taken the move from here and said, okay, that's my target. So enter there, and you can see you could hit your target up there, or you can just trail your stop underneath the swing points. So very nice move. You can see another one here, and you can see in both instances that the moves were confirmed with volume. So let me show you. This is what you want in the stock market. You want volume. Do you see? Look at this. Price gaps higher on strong volume in the middle of the trend. It's a runaway gap because it just doesn't return back there. You see? Moves up and doesn't return back. It's a runaway gap. Price moves out, doesn't return back even to this area. It does eventually return, but you can see here it's another runaway gap. So they're often you want to look for that in a market that's being hyped. And one of the ways to see if it's being hyped is how many Google searches are being done, how much is it being spoken about in financial media. That they're the kind of opportunities to look at. Now, finally, there's another gap I want to share with you called the exhaustion gap. Now, the exhaustion gap is literally the last gap you get before markets sort of collapse and move back the other way. It happens at the end of a trend. It's often followed by a reversal. Your volume may spike and then sort of fade. Now, the thing with an exhaustion gap is you can't always tell when it is going to be, because at first it could look like a runaway gap, but then it can turn into exhaustion gap. So here's a kind of an example in Microsoft. Right, you can see Microsoft gapping higher, and initially this might look like a runaway gap, right? Maybe even an intraday breakout gap. Maybe there's a little short-term flag pattern there. Do look at the other modules discussing these sort of short-term patterns. But then at this point here, that's become an exhaustion gap. So you can only see an exhaustion gap in hindsight, okay? So you can't tell if a gap is an exhaustion gap from the start. You can only see it in hindsight, but don't think this is, it's no use. It can be very useful, because don't forget, a lot of people are going to have their stops underneath that breakaway gap, or this gap here. And then once it moves lower, you can see, oh, hang on, this is a really good area for potential shorting, and that might be an opportunity for you to short. You could use the same principle, So let me show a similar sort of principle. Let me just draw this onto you. You've got that exhaustion gap, and then you've got this breakdown lower. You might say, well, okay, I want to measure from the middle of the gap to the start of the move, and say, okay, look, it's like, roughly 7% move. So I'm looking for a 7% move lower as my target. The price opens and I'm looking for a move down there. Bang, I've hit my target. Or you can trail stop. Again, your stops will be the other side of the pattern. Now there's another little tip I want to share with you with these gaps. And this is really for intraday trading, but let me just show you. If you think of these gaps, some people will refer to these gaps as windows, as rising windows, okay? Now, what I've noticed intraday, when you have a gap like that, the bottom part of the gap here is the most reliable, sort of the final defense for the gap. So if price moved higher from here and you're thinking, I don't know if this is going to fill or not, because you don't know if price is going to, the gap's going to fill or not. One of the top tips for recognizing a runaway or breakaway gap is often on a good bit of data, a good bit of news. It could be an earnings report that's not only strong, but the forward guidance in the earnings says, the company's expected to do even better things in the next quarter, and the CEO is really optimistic, and the industry is only expected to expand. That's when you see these sort of breakaway gaps, these runaway gaps. Otherwise, if it's just sort of normal day-to-day intraday trading, this still becomes very strong support. Okay, so even on some of the smaller gaps, look for the bottom part of the window. And you can see here, right, it's exactly the same to the downside. When price moves to the downside here, right, you got this sort of gap. Yes, this gap lower, right, and this little window. Again, the most reliable part of this window is this top bit here, right? So if price moves into that area, it can be a great place for selling, and it's the last place that sellers will defend. If it goes above that level, then it's going back higher again, most likely. So just like with this exhaustion gap, right? Once price broke down through there, look how price moved lower. So there you have it, folks. The 4 different types of gaps. Common gaps, just part of the normal day-to-day open and close financial markets. The breakaway gap, usually when it's breaking out of a range or a pattern, preferably on high volume, look out for those. Runaway gap, great gaps, usually on strong macro fundamental news or super hot earnings, things like that. And then those exhaustion gaps that are only seen in hindsight. You definitely want to pay attention to gaps in the stock market. They offer fantastic places to place your stops, and they're also fantastic indicators of what the market is intending to do and what the market is, the sentiment is at the very start of a new trading day or trading week. Let's go on to our next lesson. In this video, I want to give you a really helpful and practical tool for trading trendline breakouts. Now, we've looked at establishing a trend line, we've looked at the technical definition of a trend line, and what I want to show you now is how to trade a break of that trend line. Now, it's very important for me to say that when you're looking to trade a trend line breakout, this works best when you've got an instrument that you're really looking to buy or sell. Okay, so say there's a story, there's a narrative out there that a stock's overvalued and you are looking for opportunities to short that. Sometimes the very best opportunities and the very earliest sign of a reversal or a trend reversal can be on a trend line break. So let me just try to give you an example here. Now this is like Tesla stock, okay? So let's say you're looking at Tesla stock, and when you're looking at it, you're thinking, I really want to find a way to short this, and you're not entirely sure how to do it. So you're just marking in a trend line here. And when you have a trend line, you want to have at least 2 major swing points. Now this is a daily chart, okay? Now, the more significant the swing point, the more important that trend line is. So you can see here, swing point, swing point. You must have 2 major swing points touching the line. Now you don't want the trend line to be like this with price going all through it. No, you want the actual trend line for a trend line breakout to have no price the other side of it whatsoever. So you can see here, there's no price underneath this level. There's no price underneath that level. There's 2 very clear swing points. Perfect, right? And then you've got a break here. Now what you have a break and a close on the daily chart underneath. That is a trend line break, right? And you can have your stop just the other side of the trend line. Now, in terms of how far up you go, you don't need to go very far at all. Okay, just the other side of the trend line, maybe halfway up the candle previous to the breakout candle. And if that holds, it should hold really at that level and then collapse lower. If price breaks above and close, so you can see here, this is an nearly attempt. Price trying to find support on that 100, 200 exponential moving average, but in the end it doesn't, it collapses lower, right? So that's a good example of a trend line break. And you can see here, you could have quite, a short stop. See maybe 50% of that level there. And then, you've got potential for some more downside. Oh, look, and then you've got a runaway gap down there. And when you look at the on-balance volume section of this course, you might be able to look at that and say, okay, well, how was the on-balance volume when I went down through that level? What was that? A decent on-balance volume drop. And then, where are we? If that's, I'm not sure exactly where that level is, so we'll go back to the other. We'll go back to the other chart. Okay, and we'll just take that on balance volume off. But the point is that when you have that trend line break there, let me just get rid of that there. The important thing is that's an obvious place. Now, let's say you got the opposite, and you're thinking, okay, this is Tesla stock, and I'm really looking to buy this. I just can't wait to find an opportunity where I can jump into this market. Then again, okay, have a trend line. You want two major touches. Let's say you got here, you got one touch, two touch. Right? And say you're thinking, I'm looking to buy this. And then you think, oh, I've got a trend line break. And you go long. Let's say you were looking to, you had a good reason to go long. You were looking for it. Price broke through that trend line. And you had your stops just the other side of it. So you entered there, had your stop just underneath that swing point there. Okay, you're stopped out. But say you still want to go long, all you do is move the swing point, the trend line there. The key thing is always have no price either side of the trend line. And you got there, and then look down here. You have another break of the trend line. And with that other trend line break there, right, then you finally get your opportunity to go long. And you can simply enter on the break of the, you can have your stop under the swing point, and then you've got opportunity to go long there. See, these trend line breaks can be excellent opportunities. The other ways you can look at it is you can see if there's any confirmation of a trend line break on the volume. So let's just have a look here. Here's one I've actually got marked in the chart from a previous time. Okay. Look at big swing point, 1, 2, 3, and then look here, you've got a breakout, look at that, confirmed with volume, going with it, pullback price, and then the end price has moved lower. But look, there was about 10, 12 days where price is above that breakout level, and then you've got a pullback, and then you've got volume building up again, a runaway gap. So these can offer some really excellent opportunities, and some of my best trades that I've ever taken have been on trend line breakouts. Now the key, let's just choose a random stock. Let's just choose Walmart, for instance. Okay. Good consumer staple, right? And let's just take this level and think, well, where is a really important level here? Well, straight away you can see the two swing points. Look here and there, right? That's two very important swing points. So straight away, if you were looking for a trend line break, that would be your level for a trend line break to the upside. And for the downside, 1, 2, and you can argue, so look, there's a trend line break. Now you don't just want to trade them, this is important, you don't want to trade them randomly. Like, okay, there's a trend line break, I'll short. There's a trend line break to the upside, oh, I'll long. look for it when there's a reason. And this works particularly well for, say, there's a meme stock that everyone's really focused on. Say there's a really strong narrative. There's been a fantastic earnings result and a company is expected to go from strength to strength. It's all over the financial media. That's when you go to the chart and say, okay, there's been a fantastic earnings report out from Walmart. Okay, that means if I break over that trend line, I get a break and close above that on volume, I'm going to go long with it, and I'm going to have my stop just the other side of the structure. So I hope that helps. I hope you can see the power of a trend line break. Now remember, you only need 2 touches, and the important thing is don't have any price the other side of the trend. The trend line needs to have no price on it. So that can create a problem, because say for instance this happens, right? So you got here 1 touch, 2 touch, and say this is a false break, for instance, and then price goes back into that area there. All you do is you move your trend line out there, okay, underneath that swing point, and then that becomes the important trend line. But remember, you're not just trading these, whenever you see them. You want to trade them when there's a really strong narrative, and then they offer a very simple way of getting into the market with a relatively small stop placement, and you can just trail profits to the upside. So there we go. That's the trend line break and the way to trade them. Don't forget to check out lesson, where is it? It is lesson 9 on module 4, which will be coming up shortly, and that's using volume to confirm price. So volume studies will apply to this, but I don't want to complicate it at this stage. And in the next lesson, I'm going to show you how to use volume to confirm price, and you can use that as well with trend line breakout. So just remember that as you go on to the next lesson right now, that volume studies enhance trend line breaks. When you look at a chart, you are seeing the price. Here's an example. But the real question is how strong is any price move? And what volume does is it tells you whether a breakout, for instance, is likely to follow through or fade. It shows you if institutional buyers are stepping in, or maybe prices moving higher but volume stepping away. So this is a very important lesson. And today what I'm going to explore with you is how traders use this indicator called on balance volume to really confirm whether institutional players are active in the market or not. So let me first of all explain to you why this is important. Okay, so on this chart here of Apple, I have an on balance volume indicator. Now, if you just take a look at it here, you can see I've got this saved on balance volume indicator, very standard indicator, and you'll find it on most charting packages. And let's say, for instance, price sort of breaks out to a new high, right? You get excited until you realize that actually the move came on weak volume. And maybe it was more likely to be sell volume that came in. Now imagine the opposite, price breaks out and volume surges, right? That's confirmation. And that's what the on-balance volume helps you to do, to really see whether the move is believable or not. Now, this tool, the on-balance volume tool, right? Let me just show you here, right? It's one of the easiest ways to measure buying and selling pressure. It was created by Joseph Granville, and it's a cumulative line that simply adds or subtracts volume based on a day's price movement. So what the indicator does is if price closes higher, it's assuming that positive volume is added to the on-balance volume line. If price closes lower on the actual chart, it's assuming that volume is being subtracted from the cumulative total of the volume. And if price is unchanged, the on-balance volume stays flat. So over time, what it does, it gives you a running total that reflects whether buyers or sellers are in control. Now let me show you. At first you might think, oh, what use is that? Isn't it obvious if price is going up, then there's more buyers, and if price is going down, and more sellers? Well, hold on, because it's actually much more useful than you might think. So let me show you how to break down the interpretation of the on-balance volume indicator. So here's a really good example. Okay, so first of all, what it does, and this is a Microsoft, is when you have on-balance volume rising, right, and you have price rising, so you can see price is making higher lows, and you can see the on-balance volume. Look, it's clearly rising. Price is clearly rising. That tells you that you're in a strong trend, right? Now, that's the healthiest kind of rally far and away. When you're seeing prices moving higher, on-balance volume is moving higher, great, right? There's real strength in that move. And for intraday trading, you might think, well, this is a great opportunity to look for intraday long setups, okay? Because I'm going up, and you can go up to the higher time frames, the weekly and the monthly, and see how strong is this trend. And that is a very healthy trend, and it's much stronger than if you just saw price moving higher. The on-balance volume tells you actually that's likely being backed up by institutional buyers. So can you see how helpful that is? Right? Now, this is where it gets interesting, because the on-balance volume also tells you, right, when fewer buyers are showing up, and it shows you when price is likely to reverse. So if you look up here, you can see, okay, that looks like a really healthy trend. Look, we're making fresh highs. Look at those strong candles. This is looking really powerful, right? But hang on, look at the on-balance volume. So even as price is making higher lows, so price, higher low, higher high, higher low, higher high, higher low. Great, buy here. But look at the on-balance volume. Do you see the on-balance volume tells you that it's falling and there's likely fewer buyers showing up. And this drop in the on-balance volume, particularly as price is making fresh all-time highs, it's often a real warning that the market's about to stall or even reverse. So straight away you can see that the on-balance volume gives you extra information that you wouldn't have had. Right? See how useful it is? Now, let me show you again here. And I will give you a PDF handout outlining these different interpretations of the on-balance volume, so you'll be able to see for yourself. And over time, it just becomes straightforward. Right? Now, here, look, you've got an example of a clear downtrend. In Apple from January 2024 down to sort of April 2024, you can see, look, price is in a very clear downtrend. Price is moving lower, and look at the on-balance volume. The on-balance volume is also moving lower, right? Do you see how helpful that is? The on-balance volume is confirming the downtrend. And it's giving you that confirmation that sellers are dominant in volume, and they're likely pushing the market lower, and that just gives you confidence in that downtrend. Now, this is also very helpful in another way, okay? How about when you see price flat, as you've got in Microsoft here? So you've got this period, right, from December 2023 to January 2024, and you see how price is basically flat in this non-committal line for that whole period of time, right? Wow, you think, okay, well, what's going on here? Well, what the on-balance volume tells you is that there was a quiet accumulation of buyers. Smart traders or institutions may have been loading up before that breakout here. Do you see? So price is flat, but look at the on-balance volume. That's making fresh highs. Price stalled out here at that 380 region, but on-balance volume was making fresh highs, right? To see how helpful that is. Similarly, you get the same scenario when you've got price being flat here, but look, the on-balance volume moving lower, right? Showing you, look, okay, that breakout was confirmed by the on-balance volume, and that sideways price action, you could see that actually sellers were starting to accumulate and build up there. So you see, these dynamics are the reason why on-balance volume is just so powerful. It's not like predictive, it's not like the holy grail, this is the answer for all, technical questions, but it's very, very revealing. The other thing that it's fair for me to say that while the on-balance volume is simple and effective, it's not the only tool out there for volume studies. There are some other popular volume-based indicators. I think the on-balance volume is very handy, very effective, and so that's why I've given it to you in this course. But there are others for you to look at. You can look at the accumulation and distribution line. That's similar to the on-balance volume, but it adjusts where the close is in the day's range. If a stock closes near the high with high volume, then that's accumulation. Near the low, it's distribution. Right? You've also got the Chaikin money flow. You've also got the money flow index as well. That money flow index is a bit like an RSI with volume added in. And essentially what the money flow index tries to detect is overbought or oversold levels. You will need to look at these in more detail yourself if you'd like to. And of course, the biggest volume study in the futures market is probably the VWAP. But again, you can use VWAP, cumulative delta, other principles. But for today, right, on-balance volume, it is a very useful tool. And you can use it in the following ways. One, to confirm breakouts. So here's a really good example. Like, look at Apple, and this is to confirm like a breakaway gap. You've got, price moving lower, and look, and then it gaps higher, and look, you can see that this divergence was going on. You see price was making lower lows, but look at the on-balance volume, and the on-balance volume was making higher lows. Buyers were accumulating in here. Maybe there were some smart traders ahead of Apple's earnings report and they were building in longs, right? The on-balance volume tells you that, oh, look, there's accumulation down here. And then look, there's a breakaway gap. And oh, look, it's on rising volume. Do you see how useful that kind of tool is? So that's the first way you want to use it. You want to use it to confirm those breakouts. Also use it to spot divergences when you see price moving lower but the on-balance volume is moving higher. That's a great opportunity. And then you can combine on-balance volumes with moving averages or trend lines, just kind of strengthen your setups. Don't just look at the on-balance volume direction on its own. You want to use it in coordination with other technical tools. So, it works best as well, remember, in actively traded, very liquid markets. They're the environments you want to use on balance volume. And definitely it's very, very good. Tips for beginners. Some of the tips for beginners, like use it in conjunction with other signals. You want to be using it in conjunction with support and resistance. And the key thing to get into your head is price will show you the move, but volume shows you the belief behind the move. And together, they give you a much better indication of what the truth really is. It's much more helpful to see this and to develop skills reading volume and understanding, look, okay, this is great. You've got price moving higher, on balance volume moving higher. It's a strong uptrend. And then, oh, look here, you've got price moving lower. You've got on balance volume moving lower. It's a strong downtrend. Similarly here, price moving lower, on balance, strong downtrend. So you intraday looking for shorts, intraday looking for longs, right? Very, very helpful. And then don't forget when you see price, okay, price is moving lower here, but look, the on balance one is pushing higher. Hang on, alarm bell. There's probably some accumulation going on here. Or look, price is sideways, look, but the on balance one is moving up. Buyers are accumulating. Oh, it's a healthy trend again. Look, price moving up, on balance volume moving up. Great. And here, oh, you might think, oh, I really like Microsoft. I'm thinking this is going to be breaking out to a fresh new high, And then you look at the on balance one and say, well, hang on, that's a big caution. That's a big warning, right? Or maybe you get this, breakaway gap, and then you get this gap fill, and you're thinking, wow, that's a great hammer reversal from a gap fill. What a great opportunity to short with another breakaway gap, right? So these are the kind of things you can look for. I'm going to give you a PDF just outlining how to use it. Remember, there are other volume studies that you can use, but I think on balance volume is practical. It's very helpful, and it is a tool that I use day to day. I use it in the futures market, and I would have no hesitation in saying it's a great tool to use for volume studies in the stock market. The other tool you can also use is just your standard volume levels, and that can be very good just for to see whether a breakout is really legitimate or not. So particularly if you're seeing a breakout to the upside, like do you see a breakout to the upside on rising volume, you can just use the volume studies here, just your standard volume. You see a breakout here, is it on rising volume? But you see how the on balance volume does a very similar job for you, right? And you can see the spike. So you can use the on balance volume as well. I just think it's clearer to see, and there's nothing better than being in a trend either to the upside or the downside when the on balance volume is confirming it, because you just know, gosh, yes, I've got some real conviction with this. Okay, folks, on to the next lesson. Now, welcome to this session on time price opportunity. Now, in this session, what I want to start to do is reveal to you the level that professional and institutional investors go to when they're trading stocks intraday. And I want to sort of illuminate what that path would look like should you decide to go down to an intraday stock trading position. It's not for the faint-hearted, and it does take many years to master. And I certainly wouldn't recommend a casual investor or someone who's not a full-time professional to enter into it. However, should you want to look at it, I want to provide the opportunity in this course so at least you can see the beginnings of that journey. And one of the key tools that professional institutional investors use is called the time price opportunity. They also use something called the market profile. They're very similar to one another. So I'm going to show you the time price opportunity because it's slightly easier to access than a full market profile. Now, while market profile theory, it's commonly used in futures trading, but it will also be used by professional stock traders, and it will give you unique insights into where the market is accepting or rejecting price. So if you want to see where the market really values price, right, not just where price visited, then the time price opportunity is essentially a game changer, right? So I'm going to break it down into a clear, practical way so you can start applying it to your stock trading right away. Let's jump over to the charts, right? Now, when you look at this chart, this is an intraday chart for Tesla, right? You can see it's okay, and you can read the price action. Oh, there's a kind of double bottom, you know what I mean? And that's all very relevant, and that's very good. You know, a little runaway gap, retest the gap, sell off, bearish engulfing bar. There are all sorts of price action signals that you can use and take, and all the rest of it. That's fine. What I want to show is when I add the time price opportunity to it, you're going to see the market in a totally different way. And the way you use a time price opportunity, you go to technicals, profiles, and you want this one here, time price opportunity, TPO. Okay, so you just click on the TPO. I've got it up here, and then you're going to see it appear. And what you're going to see straight away is all these little areas appear. Now, what the TPO does is it tracks how much time the market spends at a given level, right? So each 30-minute bracket, it will print a mark in the profile for every sort of 30 minutes it spends in that area. Now, over the course of the session, you get this distribution curve, right? So rather than asking, what was the high and low today, you ask, where did the market accept price? And the idea is simple. The more time spent at a price, the more accepted the price is. Okay? So here's the main parts of a time price opportunity, right? So you can see it. You have the point of control, the POC. That's the price where the most time price opportunity was printed. In other words, that's the market's fairest price. That's where price spent the most amount of time in the day. Now the value area, this is the range that includes 70% of the time price opportunities. And this is where the bulk of the trading occurred, where buyers and sellers agreed the most within the value area high and the value area low. Now, single prints or tails, single prints are when price took very little time spent, and it's often a sign of rejection. You can see here, look, little time, little time, little time, little time, little time, wick, rejection. And what happens is in stocks, these time price opportunities help you identify support zones, resistance zones, and breakout zones based not just on the price, but on the level of participation. So it's a kind of proxy for volume because you can see where people are most interested and where transactions are most often occurring. Now that helps you move from trading based on where price touched to where price has been accepted. And this is very useful for identifying high conviction support and resistance areas. So in other words, if price is trading outside its value area, you know that it's exploring, right, new prices. It could be building value at new levels. Just if you look down here, you see this. You got this day on 9th of June. Value area low, value area high. Price moves up throughout the session up to the value area high, and look, it breaks out above the value area high. And what does it do? It pushes away from it. So it's telling you straight away, look, we're rejecting this, we're on price discovery mode. We're looking for a new area. So for instance, that all of a sudden becomes a technical possible trade. Okay, if you had a good reason to buy, Tesla stock on this day, right? What you could have done is simply entered on the close of that candle, stop maybe the other side of the point of control, and then just trailed your stop up as you went. And you can see that would have worked very nicely. And look, another day, value area high breaks above, goes higher. Okay, below the value area low, breaks out. And look here, the following day, price tests the previous value area low and the point of control and moves lower. Do you see how it works? This sort of stepping factor with the point of control and the value area low, value area high, essentially acting as supercharged support and resistance levels. So you can see here, look at this day here on the 23rd of June, price breaks to that level, and then look here, right? Here's the 24th of June, and look at this. This is the candle on the opening bell. And what does it tell you? It says price is looking to move below the previous value area for the previous day. So it's saying, no, we don't accept that. And look at this single prints here. Single print, 1, 2, 3, all those single prints marked by that sort of white, that huge bullish candle. In other words, price took hardly any time there at all. And look what happened. Price broke down and just slapped through that. So what you can do, you can use it on TradingView, Bookmap, Sierra charts. You can use market profile visuals. The point of control, again, really good intraday. Monitor, does it hold? Does it support? And it just helps you with another area of stop placement. And you can combine this with traditional technicals like moving averages, candlestick patterns, momentum tools to build high probability setups, you see. So time price opportunity isn't just for futures traders. As a stock trader, particularly if you're doing intraday, you can use a time price opportunity to gain insight, not into just what price did, but where the market actually believes value is. Okay, so you can see, if you come to a new day, right? So here's an obvious one. Okay, new day, and the market profile starts at 2:30 because that's when the market opens. So if you see here these two time price opportunities, this is from like the end of the session, right, until the start of the next session at 2:30 UK time. That's 9:30 Eastern. So this is the one you want to look at. This is when most business is happening. So you look here, look at the open. It opens above the previous day value area high. So what's that telling you? It's telling you it's a very high probability the price wants to move higher. That means that value area low can be a great area to look for buying in. You could maybe drop down to the 15-minute chart. Now, please, if this is new to you, I have years of experience in the financial markets, and I do realize how difficult and challenging this is. So I'm not encouraging you to go down that route. When you're starting stock trading and the investing, it's daily, weekly, monthly. Right? That's hard enough. It really is, without dropping down to 15-minute charts and things like that. It takes an enormous amount of time, and to give you a sense of that, I work on the E-mini futures using Market Profile. One market, right? I'm a professional and I have a wealth of knowledge, and I choose to work on one market for futures, right? Maybe a little bit in gold bonds, but you get the picture. So, but I do want you to know what the professional tools are. So should you go into it, you know why. Like here, pushes above value here, like price opens above previous day value. Do you see how that helps with stops? So stops for the intraday could easily be placed nice and tight below the previous day value area low, right? Stops below the previous day value area low, below the previous day value area low. Oh, you got any price discovery? Oh, above the previous value area high, right? Oh, above the previous value area high. And do you see how it just, that step? It's best to think of it like turbocharged support and resistance, but understand how it's fundamentally built, which is by time, price opportunity. It's the amount of time in the area, and that's proxy for volume, because the more time in an area, the more volume that's being exchanged. Okay, so that's the principles for it. And once you start seeing value areas and time spent, you probably won't look at price the same way again. Excellent for intraday execution, excellent for reference points. Really helps with breakout and mean reversions, and really helps to spot imbalanced markets, right? Because you can come to the very start. So you can see here, it's kind of obvious, but look, from the very first day, look at that. There's a huge imbalance, right? And then there's price discovery, which ultimately gets rejected, and we collapse back down. Okay, folks, I hope that helps. Hope to give you some insights in what if you're going to go down the intraday chart, how Market Profile is one of those tools that professional traders use, and it's probably the most important one structurally, and helps you gauge the overall direction and the moves that are coming. And I think if you had to take one major profile with you, definitely take time price opportunity.